an overweight in any of the individual GIC sectors. So we're not going to be overweight energy. We're not going to be underweight industrials. We're not going to be overweight technology. The idea is to keep the cost of these products low and have our clients experience market beta. So that'll be the market series. Those will be really tight to the benchmark or their respective benchmark. Then there's an iteration called the factor enhanced series. And there's two different versions of that. So it's you kind of see it as going from left to right. You're kind of adding layers onto the onion. So you're going to be benchmark hugging in the market series, roughly a 2% tracking error. And then the factor enhanced series is going to have a couple of exposures. One is value plus quality, and the other one is value plus quality plus momentum. So if any of you are familiar with the DFA funds, what they do is they have a value plus momentum plus quality bias. And if you're, value plus quality. And if you're familiar with the AQR managed funds, they have that momentum component. So they're value, quality, and momentum. So that's kind of a spin-off of those funds. So if you're looking for a little bit more juice, a little bit more market beta, I would look towards the factor enhanced series and include the portfolios with value, quality, and momentum within your clients' portfolios. And then last but not least, and this has become somewhat popular lately, is this impact series. So anybody who anybody who may be opposed to pornography or nuclear weapons, or in the case of the unfortunate incidents down in Florida where we have a school shooting, we've had a couple clients call in and say they don't want to hold Smith & Wesson and any of the gun manufacturers anymore. So that is another way for us to get exposure to companies that have high sustainability ratings, both from a strict screening process, so you can completely eliminate pornography, or child labor companies that have issues with child labor laws. And for instance, Nike overseas has had issues for decades in that regards, especially in Southeast Asia. So these are the types of portfolios that a lot of people, both on the East Coast and the West Coast, tend to kind of fall in line and want to make more of an impact on the environment and the social aspect of our political environment. So to each their own. If the clients want it, we give it to them. If they don't want it, hey, market series and factor enhanced will definitely work too. So let's kind of go into slide 7 if we could. And Envestnet PMC manages roughly about $1.4 billion in index strategies, both market beta and factor enhanced. So we're highly entrenched in this market. We're not just a startup in that regard. And this number grows dramatically on our platform. Every single day I see new QP accounts come onto the platform. And it's been a really, really great growth story for us. The solutions start at $100,000 minimums, and then you can also use them in the UMA as well, which is a nice feature. And then if you want to get into that custom tax managed realm, we manage roughly $1.3 billion, and I'll speak to that briefly now. We have a couple iterations of that market series where you can apply a tax optimization to the product, where you're trying to eliminate short-term gains and limit as much as we can long-term gains in the portfolio. And then also we have a tax transition version where we've had clients come in the door with very, very concentrated holdings, maybe 5 or 10 stock positions, and they have huge embedded unrealized gains, and they want to go away from that concentration in their equity portfolio and move more to a diversified ETF-like product that you can get 100 to 125 securities in. And we have to do that over a period of time, call it 3, 5, 7, or 10 years. So I just recently had a client come in with $1 million of unrealized gains, and the goal is to unwind the portfolio over the course of 11 years. And that may change from year to year. So right now we have a capital gains budget for that particular client for $100,000 this year. But in 2019, that number could go down to 80, 85,000. So we got to be a little more restrictive on that account in 2019. And then maybe there's some lost carry forwards from a real estate property or some other investments off platform. Maybe the realized gain budget will go up in 2020 to about 150,000. So it's very, very customized. So it's been a great product for us so far in that regard. And you know, if you have a client coming in from a wirehouse or maybe has 40 or 50 stock positions, we can try and make those work as well. So rather than ripping off the Band-Aid and seeing how much unrealized, how many realized gains we can incorporate, we're trying to mitigate that tax liability as much as possible. So Tom, let's move over to slide 9, if we could. And the quantitative portfolio market series, as I discussed, is really kind of that tight tracking error, beta exposure. And these are the products, right? So you have all cap, you have 3 iterations of large cap with the core, growth, and value. You also have the small cap core. And then on the international side, we have an international developed markets one. And then we also have an emerging markets ADR portfolio, which is, there aren't too many of those on the platform in terms of SMAs. So it's a really good way to get cheap market beta exposure in the EM space. Let's move over to slide 12, if we could, Tom. And this is the factor enhanced iteration that I was talking about. So there's 2 different versions. One is value and quality only, and then another is value, momentum, plus quality. And value is the tendency for cheap assets to outperform expensive assets, right? So value really kind of comes into play if I can get a good individual stock position at a cheaper price, right? And that they may have stronger book to value ratios, or you know, they may have more cash on the books, and those tend to outperform in downward trending market environments like we discussed in the active passive Franklin Templeton portfolios last week. Momentum is something I like to study in the technical side of the world. It proves that the tendency for assets that perform well in the last 12 months tend to outperform also their peers over the next 6 months. And that really kind of has really shown through in the market over the last 2, actually 3 years. We've seen a lot of momentum in the marketplace, especially in technology. And then quality, the tendency for higher quality companies, those that are more profitable and safer, like I said, outperform lower quality companies. This is a stated fact, okay? Can we move to slide 13, Tom? So here are the different iterations of the factor enhanced portfolios. You have the value plus momentum plus quality in large cap, small cap, and all cap. There's no large cap growth or large cap value in this particular case. We have the international ADR. We have an emerging markets portfolio, and we also have a new global equity portfolio just for those clients that want a global equity exposure but just don't have enough money to do a large cap sleeve, a small cap sleeve, and an international. This gets them a good tilt towards U.S. equities at about 60% and 40% international in one product. Also on the value and quality side, large cap, small, all cap, and then international and ADR. And then we have a low volatility tilt as well in the large cap space right now. And we're actually working on an international equity version of that low volatility. So if you have a client that wants equity exposure, but they're a little more risk adverse, than that low volatility portfolio may come into play in terms of your discussions. All right, so how has factor-based investing driven investing since inception not since inception of the market, but going back to, like, we did a study back to 1957 on the next slide, Tom. And what we've seen is that they have negative correlations to one another. So we actually want something like that, or essentially neutral correlations. So one is not necessarily driving the other. So you could see how a $1 investment dating back to 1957 has grown to 2017, and you're turning $1 into $9 and $10 respectively on the value and quality side. But you can really see how the implementation of momentum in the portfolio can really drive the performance of overlying equity exposure. And so if you go back to 1957 and you invest $1 and you're investing only in momentum securities, that $1 is now turned into 70. So if you have a client that wants a little more juice in their portfolio, we've seen the momentum piece become very, very popular with our individual clients. Okay. Let's go to slide 16, if we could, Tom. So how has Factor performed? This is actually through the third quarter of last year, but what you can see is that value has not done particularly well in the year 2017, and I don't think that's any really surprise for anybody. Quality was fairly neutral for the year. It ended up about close to 5%, but momentum had really taken stronghold in the portfolios in 2017, and has really kind of continued that all the way into 2018. So it's one of those things where, you know, value may outperform momentum and quality at some point in time. Quality may outperform value and momentum. It's really impossible to dictate when those things are actually going to happen. So it's nice to have a flavor of value, momentum, and quality, or just value and quality if you want something that's a little has a little less juice in it. And then let's move to slide 18. I just want to touch on the large cap factor enhanced portfolios, that value plus momentum plus quality. We're still finalizing, actually the 12/31 numbers have just come out, but when I gave this to Tom, it didn't have the current numbers, so I can get you guys new numbers. But these portfolios have really done quite well. You'll notice that the returns are outperforming on a quarterly basis, just because that momentum has really been a driver in 2017. And if we move on to slide 19, Tom, it actually takes our performance illustrations back 10 years, and you can really see that 10-year number over in the lower right-hand corner has really kind of boosted performance versus the Russell 1000, and a lot of that has to do with momentum in the marketplace. And then the up and down capture ratios are fantastic in this portfolio, and then the Sharpe ratios are great as well. We're looking at a 66 Sharpe ratio. And the beta, you'll notice the beta on this in the upper left-hand corner is 1.04. That really kind of comes from the momentum piece. If you want a lower beta portfolio, strip it out and just use the value and the quality. Okay, but over in the right-hand side, upper right-hand corner, you can really see the drivers of cumulative excess return over the last 10 years, and it's really quite apparent in these portfolios, especially with that momentum piece. You know, the same story can be told for all cap and small cap as well. So Tom, if you want to just briefly bring up those slides on slide 21 and 23, you can see how those excess returns are really kind of coming in the portfolio. You're going to see a lot stronger momentum on the small cap and the international side than you would large cap. So I would expect higher excess returns in the small cap portfolio and the international, if you're including the factor enhanced portfolios in your clientele's portfolios. So that concludes the factor enhanced piece. Let's move to slide 25 about the impact quantitative portfolio. So PMC has been looking at impact.
A question?
Yeah, go ahead.
Just before we move on from the first section.
Yeah.
From you mentioned before a minimum $100,000 investment, number one. The other thing is from a pure structure standpoint, this is a SMA structure?
That's right. That's right.
Okay.
So the client, when they look at their statements, they're going to see underlying individual equity securities. Okay, it's a lot. You're going to see 100 to, roughly 100 individual securities. So far different feel than a lower tier retail investor that only has $20,000 to invest. They're going to be investing in exclusively mutual funds and ETFs.
So if I can just stop here and give a little bit of commercial, because this has been kind of the drum I've been banging, at our meetings as much as possible. I think as people have gotten involved in the managed account business, and Russ, you can add some color to this if you can as well. Obviously, what they've been doing primarily has been either sub-advised mutual fund business or fund strategist portfolios. And with the fund strategist portfolios, which we've essentially featured up and through the first 4 weeks, it's a great opportunity where a strategist like a PMC or an American Funds or a Franklin is going to come in and put together this best in breed recipe, asset allocation of various mutual funds and ETFs, which have expenses at their own level, in addition, obviously, to your fee and our program fees as well. And amazingly, they still do that very efficiently, and we're able to put together portfolios at 160, 150, 140 when you're making 100 or 1 point on that, which is very, very competitive. The separately managed account has always been something I've been very much in favor of for clients that have the money to invest in it, and especially a situation like this where they're still fairly well diversified, in terms of global and all cap as a bigger solution, because you have the beneficial ownership of the securities. So unlike buying a mutual fund that's been around for 50 years, where there's legacy issues, where there's built-in tax gains, where there's phantom taxes at the end of the year when your client can't understand why they're getting a 1099 for 10% distribution when their account went down 15. All of that is eliminated with a separately managed account. This is a segregated, privately owned account with individual securities registered directly into your client's name, and from a tax standpoint, thus the ability to tax manage it as well. But you're paying taxes on whatever dividends you earn, whatever capital gains are actually realized, not on unrealized gains. So it makes it, from a tax standpoint, very, very aggressive and very efficient. The other thing from a cost standpoint is in our portfolios, we already have an arrangement with Pershing where all of the trading, buys, sells, whether it's mutual fund, ETF, or individual stock, are all baked into the pricing. So it actually looks like and feels like, because it is, you're not paying that fund level or ETF level pricing, as small as it might be. That's eliminated, and we're covering the cost in the program fee. So it makes for a very, very cost-effective program. And I don't want to derail us there, but I think it's important, because I think the average person tuned in here, and I would say the average TFS advisor, is, if they're exposed to managed accounts, it's going to be on the fund strategist side. And in accounts where it makes sense, you really, really want to look at how some of the separately managed accounts stack up, either standalone or in the context of the UMA. Russ, anything if you want to add to that?
Yeah, I mean, it's just there are many combinations that can be used on the platform, and you could use a quantitative portfolio as your equity sleeve and put the tax optimization version on it, and you can reduce your client's tax liability, right? And for the fixed income sleeve, you could use our proprietary PMC portfolios on the fund strategist side. Maybe we're talking about $150,000 client. So you do a global equity QP, and then you use one of our very conservative FSP or fund strategist portfolios. Or you can use a BlackRock or any of the other fund strategists. Whatever you guys want to choose, it's fine, right? You have tons and tons of options, but this is a way for your client to get the feel of an institutional investor while only having $100,000 to be invested in equity. So it is a differentiator. They get market beta, passive market beta exposure, but they're holding the underlying securities. And the reason why that is important is, let's say the index, the Russell 1000, for example, is up 10% in 2017. Within that individual portfolio of 100 securities, there could be individual securities that are trading at a loss. And for instance, GE is a popular Russell 1000 name, and we all saw what happened to GE in 2017. They were down, call it 30%, right? So the overall client's portfolio is up 10%, but GE is down 30. What you can do is you can tax loss harvest GE and try to mitigate some of those unrealized gains that the client has in the portfolio. So you're building up losses in the portfolio over time. A lot of our advisors on the platform make the mistake of, when they're using SMAs, they only tax loss harvest in late November and early December, right before the end of the year. But you could tax loss harvest at any point in time on the platform. So for instance, in February, we saw a lot of volatility in the market. Market was down about 7% in 3 days. That's a really good opportunity to tax loss harvest. You cannot do that necessarily in an ETF, right? If you own an ETF, you own the blanket of securities, and if that particular ETF is up 10%, even though it's not spitting off taxable gains, if you ever had to sell off that ETF, you have to sell it off as a gain. So this is a great way to mitigate your client's unrealized gain liability. Okay, Tom, would you agree with that?
Absolutely, I appreciate it. Thanks.
Okay. No problem. So let's move, for the sake of time, let's move to slide 28. This is the impact QPs. I was talking about some of the exclusions you can have in regards to the companies within the portfolio. These QPs, can exclude adult entertainment, firearm, gambling, military weapons, you name it, we do it. And the portfolio is rebalanced annually. So if you have clients that any of these issues they're not in favor of, and they want to invest more responsibly from a social perspective, these are the types of portfolios that we see some of our clients utilizing today. So I was talking a little bit about taxes, and I was kind of teeing us up for slide 31, I'm sorry. So the potential for tax alpha in your client's portfolio is massive, right? So for an additional 5 basis points, that we offer the tax optimized quantitative portfolio. And what we did is we ran a study, and what we found is that the median annualized tax alpha in an SMA is 60 basis points. So you're paying a mere 5 basis points additional cost to save your clients 60 basis points, or generate is a better word, generate 60 basis points of annualized tax alpha. That is incredibly huge when you're talking about individual equity security portfolios. So I would like to also talk about slide 33, if we could, Tom. The great thing about the quantitative portfolios is they're customizable. So if your client works at, for instance, Ernst & Young, and has access to other clients' financial, or other companies' financial statements, and they have a huge laundry list of individual securities that they have to restrict because they are not allowed to trade those, you can put in those individual security level restrictions. So my wife used to work at Ernst & Young. She had a list of about 40 companies that she could not buy, and this was a way for her to guarantee that she didn't have any exposure to those companies. And also, if your client has large holdings in technology off the platform, or they have a technology ETF that they're just in love with, and you want to put an industry level restriction on technology within the quantitative portfolio, so you don't have an overweight across your client's entire portfolio, you can also restrict industry level applications here. So I think that's really important. And then slide 34 really kind of summarizes the whole QP family, right? You have the UMA version, so you can get it as low as $60,000 in the UMA structure. SMA, just a standalone separately managed account beta version, $100,000. If you want to apply the tax optimization to the portfolio, the minimum jumps up to $200,000. And then those custom SMA, that transition quantitative portfolio where client has a concentrated equity position, that minimum is $750,000. Okay, and then on the factor enhanced side, you're looking at UMA versions and SMA versions of $100,000 each. So how does this stack up on pricing? This will be my last slide here. The ETF category, and this is on slide 35. The ETF category averages are over on the right-hand side, and you can see the expense ratios there. And then the SMA beta versions of the quantitative portfolio, as I said, were priced very, very low. We want to make sure that the client has ETF-like exposure in an SMA. And you could see that the pricing is very, very in line with the ETF category average. And then what you'll see, and I'm sorry, I made a misquote there. So the tax optimized version is an additional 10 basis points, not 5. So if you look over to the right there, to the right of ETF category averages, if I look at all cap, for instance, all cap core, you jump from the SMA beta version of 20 basis points up to 30. And then that customized tax transition version is an additional 5 basis points. So sorry about that, that misquote there. So if you want to jump from the SMA beta version to the tax optimized, 10 additional basis points. For an additional 5 basis points in addition to the tax optimized, if you're doing a customized tax transition strategy, you're looking at 5 basis points in addition to the tax optimized, or 15 basis points as a whole versus the SMA beta version. That's a lot of information. I'm gonna pause for questions before we move on. Okay. So Tom, if we could bring up the active passive portfolios deck. And we kind of touched on a lot of the foundation within the Franklin Templeton portfolios last week. So this is just a different iteration of the active passive portfolios that we offered with Franklin Templeton. The only real difference is some of the active managers that we're using on the active side of the portfolio, and this particular portfolio has a very, very long track record, or much longer than the Franklin Templeton portfolio. So the Franklin Templeton portfolios were just released last year. The active PMC active passive version, where we're not including Franklin Templeton as a fund family, has a track record going back more than 5 years. So it's a very, very impressive track record. We're actually outperforming on a gross basis, both against the benchmarks. So if you look across the board, it's a really impressive series. I encourage you to go on to the research tab and really kind of explore the PMC active passive portfolios. I think they really make sense at a low cost solution. So Tom's kind of skipped ahead for me. He kind of reading my mind here. So we're on slide 6. These are the allocations for the PMC active passive portfolios. Not a whole lot different than what you've seen in the past. When we were talking about the Franklin Templeton active passive portfolios, and even the PMC American Funds active core portfolios. So 7 risk tolerances. This is the theme across the platform in its entirety, whether it's our proprietary products or another fund family like BlackRock or S&P for that matter. And then we also have a tax-sensitive version of this one. So if you have those taxable accounts and you want to have some muni bond exposure, we have that within this portfolio series. So just to highlight again the benefits of active passive management, let's go to slide 8, Tom. I'm not going to really focus in on these too much because we talked about them last week, but the benefits of active management is that upside potential, right? You have the ability to outperform the benchmark. In an ETF, you do not. You cannot outperform the benchmark in an ETF. But you also have the benefits of downside protection, and really, really good active managers really protect to the downside. So like I was saying last week, if you lose 33% of your portfolio value, it doesn't take 33% on the upside to break even, it takes 50. So the more we could protect on the downside, the better, especially for our clients that are closer to retirement. Obviously, the challenges of active management, they're more expensive than ETFs, right? That's the main reason and the main focus of why we've seen so much money move from active management to passive management. And then obviously the benefits of passive management, low fees, and the ability to perform in line with the index. But the challenge is you should not expect to exceed the index, and then you have limited or essentially zero downside protection there. Okay. So I've gone over the active passive strategies before, and the study and the white paper, but I think what's really cool is slide 11, Tom, if we can move to that. What you'll see is that skilled managers, ones that consistently produce active returns across all asset classes, tend to have a lower expense ratio. Usually they kind of go hand in hand, right? So if I'm really good at what I do, in the investing world and I have really, really strong performance and I see an inflow of assets or AUM into my fund, that inherently brings the cost of those funds down. So I'm not surprised to see that number. Also, portfolio turnover tends to be lower for skilled managers than it is for unskilled. The only difference is on the fixed income side, you're going to see much more turnover in the mutual fund space by skilled managers, and that's a really cool point to notice, is that on the fixed income side, you actually want more trading to take advantages of those really, really slim margins for profit. And then again, skilled managers tend to have much better downside capture ratios than unskilled managers. Over on the right-hand side, you can see that anything under 100 is a good or better down capture ratio, and then unskilled managers are above 100, which is not where you want to be. So slide 13, we use proprietary PMC funds within these portfolios. There's really just two of them, right? So PMC Core Fixed Income, it's ticker PMFIX when you're looking at the research tab, and then PMC Diversified Equity Portfolio, PMDEX. And this is a way for our retail investors to get access to our institutional partners. So Delaware, Schroders, Neuberger Berman, BNY Mellon, Boston Partners, and Epic, all institutional shops, are all embedded within these funds. So if we look on slide 14, PMC Core Fixed Income Fund is really quite simple. 50% Schroders, 50% Neuberger Berman, both fantastic fixed income shops. And then in the PMDEX side, the reason why I was talking about QPs first is the PMC Factor Enhanced portfolio is a real staple here on the large cap side. We're also including BNY Mellon Large Cap Growth, Boston Partners Large Cap Value, Delaware Small Cap Core, Epic on the international side, and then we're getting a little bit of passive exposure. We wanted to bring the fees down a little bit in the international space. So we're using 5% international ADR and 4% international emerging markets on the QP side. So those are the funds in a nutshell. You also see all that stuff on the research tab. And then slide 16 is, again, a closer look at the allocations. So we have a slight overweight in this product to large cap versus small. You're going to see a little more active exposure to domestic and international equity markets versus fixed income in this product. Just a very, very slight tilt. And then that slight overweight to international versus US is really just a common theme throughout our portfolios right now. And then just to give you guys a heads up on the line as to what you can expect, if I was looking at a balanced or a moderate portfolio, you're going to see, let's see, I want to get you the exact breakdowns here. So for our balanced portfolio, you're going to have 27% large cap core invested in the Fidelity 500 index. So that's your passive exposure, very, very cheap passive exposure. And then the PMC Diversified Equity, that PMDEX fund, is 24%. Okay. And then we have 9% exposure to the Fidelity index fund as well. Then you're going to have the PMC Core Fixed Income at 20%. The Fidelity US bond at 9%, and then we have some high yield exposure like we do in the active core portfolios with American funds with Columbia. That's going to be at 3%, and then the PIMCO foreign bond as well at 6%. So a really, really good quality lineup at a very, very low minimum. So the minimums on this particular product are $10,000. I forgot to mention that earlier. Do we have any questions on the active passive portfolios before I move on? Okay, you guys are a talkative group this morning. Let's go with the last bell of the ball, and that will be our PMC Paradigm Liquid Alternatives. This is a component. You guys went through the liquid endowment strategies with, I believe, my colleague Regan in the first week. And this is just a piece or a sliver of that portfolio. So if your clients want to mitigate tail risk, and I'm not going to bore you with conditional value risk or CVAR, but tail risk is a number that we really kind of focus in on in the alternative space. And that's to the left-hand side of a normal distribution curve. So Tom, if we could slide over to slide number 4, I'll talk really briefly about tail risk. So returns distributions for the Russell 3000 really kind of skew towards the negative. All right. So even though we're in an up market, there are days and individual days that on the left-hand side of the tail can be really, really disastrous to a client's portfolio, especially if they decide to sell. So the idea to mitigate tail risk management is to control conditional value at risk, and you could do that by having lower market beta, and you can do so in the liquid alternative space. So if your clients are risk adverse, I would recommend maybe putting a piece of these portfolios on to maybe the S&P equity portfolio that you're running, or the PMC active passive portfolios, or the PMC American Funds active core portfolios, or those Franklin Templeton portfolios we talked about. So this is something you would kind of bolt on, and we would recommend not putting more than 25% of your client's portfolio in these types of products, because they're not going to track the overall equity markets at all. So at times when the market, for instance, last year was really running, the clients are going to kind of focus in on the returns of the liquid alternatives piece, and they're going to say, well, advisor, I was only up 4% in this particular portfolio. What's going on here? The point is, you're not trying to get upside in these portfolios, you're trying to get downside protection. Okay. So if we could look at some stats on the next slide, slide 5, I was talking about those black swan events, so those negative days. So in theory, if you guys have read the Nassim Taleb book, it's exceptionally boring. It's called Black Swan. But if you decide that you're really bored and you want to read it, I'll save you the time here, and I'll give you a one-page synopsis, right? So theoretically, we should have only seen 3 standard deviation days in the market dating back to January 1st of 1928. Those days should have only occurred 61 times. So a movement plus or minus 3.53%. That's considered a black swan event. In reality, that number is well above that, right? So rather than 61 days being a black swan event, it's actually 380. And of those 380 days, you have 14 additional days that skew to the negative side. So that's where that tail risk really kind of comes into play. And why that's really important is on slide 7. What our clients do in the marketplace is really bad for their overall portfolio's performance in the long term. So if we could skip over 2 slides, Tom, to the irrational investor behavior slide. I think it's slide 7. What our clients tend to do, and this is a really great chart, this is a great behavioral finance chart. On the equity fund flows, you'll see a dark blue, and whenever you see positive, it'll be higher. And then when you see fixed income fund flows, that'll be in the light blue, so they'll be higher than that 0 point there. So what you'll see our clients do, and especially in the tech bubble, is that they will buy into the market rally and sell at the bottom, right? So they buy in at 2000, and then in 2002, you see where the equity fund flows are going? They're going out, right? So our clients buy at highs and sell at lows, right? And so that really kind of played into the effect of the market crash in 2008, right? Selling at the low. So after your clients experienced double-digit losses in their portfolio, they sold out. And if you look on the right-hand side from 2009 to about 2013, you see fixed income flows increasing as the market goes up. So the clients sold out at the bottom of the market in 2009 and didn't start purchasing equities on a greater scale until 2013. So they essentially missed out on 4 years of upticking performance. That is a huge, huge problem from a long-term investor's behavior. And if you look at any Dalbar study, the average investor's return is about 2% over the last 20 years, and the S&P 500 is about 10 per year. So this is very detrimental to your client's overall portfolio experience. So if they are risk adverse, it is maybe a good idea to invest in liquid alternatives. Okay, and does everybody on the line, is everybody familiar with liquid alternatives? Okay. They can be a little expensive. I will totally admit that. But I think, Tom, if we could slide onto page 15 of the deck, I think there's different ways to kind of slice it, right? So we want to kind of take off this whole broad-based shell called liquid alternatives and kind of break it down into individual style classifications. So you'll see hedged equity, you'll see multi-strat, you'll see equity arbitrage. But look over on the right-hand side of the chart. Those are the average market betas that you're going to experience within these sub-asset classes. So you look at alternative fixed income, beta of 0 versus the equity markets. Fixed income long-short credit, anywhere from 0 to 0.4. Market neutral. Market neutral really kind of, the name kind of stands for itself, right? 0 beta. You're going to be neutral one way or the other. And the idea of managed futures is to also have a beta as close to 0. So this is a great way to break out what the individual style classifications are for liquid alternatives. And there are a lot of them out there, but we don't have a lot on our approved list. There's a lot of due diligence that goes in behind these products. And I think it's just something that we really kind of do a really good job at. So if we move over to slide 18, Tom, which liquid alternative products should you use? There's really kind of 3 different versions of the liquid alts paradigm portfolios. One is the fixed income complement, one is the portfolio diversifier, and one is the equity complement. So if you're seeking complementary exposure to your fixed income allocation, fixed income complement is probably a good product to use. If you want to complement your existing equity allocation, that equity complement is a really good product to use. It's going to have a higher market beta. If your client's in that conservative growth to like moderate growth risk tolerance, probably you're going to go down in the middle here for the portfolio diversifier. It's really kind of a good combination between the fixed income complement and the equity complement portfolios. What do these portfolios look like and what are the funds within them? That's on slide 19. So you have the fixed income complement portfolio on the left-hand side, $25,000 minimum. You're going to have some AQR multi-strat. You're going to have some BlackRock Strategic Income Fund, which has the ability to go plus or minus on the duration scale to hedge against rising interest rates. You have a great fund in that Eaton Vance Global Macro Absolute Return Fund, Goldman Sachs Strategic Income, Iron Strategic Income, RBC Blue Bay Absolute Return, and then you have that Vanguard Market Neutral. So a lot of familiar names that you guys have probably seen if you're doing some liquid alt research. Over to the right-hand side is a portfolio diversifier, so you're kind of picking up a little bit of that equity complement on the right-hand side, so you're picking up a little bit of that AQR managed futures. You're trading out of the BlackRock Strategic Income and going into that Boston Partners Global Long Short portfolio. You're also picking up that Gateway Fund, which is a hedged equity strategy. And then you're also picking up the Merger Fund as well. And then and that's a $50,000 portfolio. And then over on the right-hand side, I'm not going to read off all the funds again, but you can see the weights of the equity complement portfolio. It's geared much more to have a little bit higher beta than obviously the fixed income complement. So last but not least, last slide of the morning here. How much should I allocate to my client's portfolio? There really isn't a finite number that anybody should live by. You should have, if you're considering liquid alternatives, you should have a minimum of 10%. Otherwise, it's really essentially pointless to have in a client portfolio. It's really not going to protect too much on the downside. The suggested ranges are anywhere from 20 to 25%. Do not go anywhere over 40%. It's just way too high. From a liquid alternatives portfolio, your client's just not going to get enough market beta exposure for them to be happy. So any questions regarding those portfolios?
While we're waiting for questions, just to kind of follow up on that point and really stress at home, because we've seen this happen, some internally, mostly externally, where, unfortunately, we as advisors get smart and we, know that the market is overheated and all of a sudden we're going to get very contrarian or very defensive or alternative heavy. and all of a sudden the market continues to trudge ahead for another 3 or 4 years, and now you've been betting against it in a way that's almost unrecoverable. And, in this business, sins of omission are bad, but sins of commission are worse. And that's going to be a tough one. I would be very, very careful to stay within these suggested rails, because again, this is, while you can have an equity or fixed income leaning, this is really ideally suited for alternative to market exposure. So, I would strongly suggest and make sure that when we're building portfolios, that we're looking to make sure that we don't exceed, those limits at all.
Yeah, and that's a great point, Tom. And something that I really have seen in the business over the last 12 years is these products tend to be very popular after a market correction, right? So they've already experienced really strong performance relative to the market during market corrections, but we as advisors and consultants suggest these products after the fact. It's kind of like I buy insurance on my house in case of a fire, but the only time it really kind of benefits is if my house is on fire, right? I don't buy fire insurance after my house is already burnt down to the ground. So if you, like Tom was saying, if you feel like you want to have a contrarian piece in your portfolio, you want to have some tail risk mitigation, it's better to put that in the portfolio, whether ours or any other liquid alternatives product, in the product before a market correction, obviously, right? And that's a pretty obvious statement there, but I've seen it a lot. The clients get scared of market drawdowns, and then they go into these products after the fact, and then they are disappointed in the product's performance as the market really kind of rips back up and corrects itself.
Other questions? We had a question come through. I think it was partial on chat, so I'm going to try to see if we can answer it. If not, I'm going to get back to this individual separately. Basically, the question was distribution-focused strategy, such as a 5% withdrawal to complement or compete with an annuity distribution. I don't know if that was meant to be, is this in response to liquid alternatives or one of the other portfolios, or would any of them be suitable? I would say, and Russ, you can probably agree, I don't think that the liquid alternatives would be something that we'd be looking to put in there as a conservative portfolio to provide a 5% distribution rate. I think it's really, that hedging balancing act that we're looking to diversify. But if I'm understanding what I think the question to be is whether it's something we talked about today or in your experience of doing your job for Envestnet, is there a particular SMA or portfolio that you put together or FSP that would have been designed to act as a complement or a competition to that guy that's out there selling the variable annuity with a 5%, guaranteed minimum income or something like that?
Yeah, I mean, obviously insurance is far different than equity and fixed income in regards to any kind of portfolio. So there's not going to be any type of guarantee. But if you do have a client that is distributing, if I'm understanding the question correctly, ones that are distributing or peeling away income from the portfolio, I think probably the best product that we've talked about throughout the entire series is probably that PMC American Funds Active Income portfolio. So at least you're getting some level of quote unquote guaranteed income, but it's not going to be anywhere near that 5% realm. I mean, in order to get a 5% guarantee on the fixed income side, you really kind of have to reach into that high yield or lower credit quality space, because I mean, let's face it, 10-year treasuries are below 3%. So yeah, I would probably look towards that. And then also the BlackRock portfolios on the FSP side, they have target income portfolios. I think they have one that has a target income of 5%, so they're going to have much higher exposure to high yield corporates and mortgage-backed securities, and then floating rate bonds as well. So something to look into. You know, this doesn't just have to be a commercial for PMC. It could be a commercial for any product, for that matter.
Yeah, I think that's important because, again, for any of the advisors, if you have questions like that, definitely fire them through me, and I can use our team to get answers to that to help narrow it down, simplify the research. You know, just because, again, I think the point here that's valid. Again, this is not necessarily a wrap on the variable annuity or even on the EIA or fixed annuity, but again, guarantees come with high costs, whether they're actual hard dollar costs or their opportunity costs. And, you know, for somebody like myself that's been a, you know, almost exclusively equity investor, pedal to the metal for the last 30 years, you're going to have a tough time convincing me that that's not the way, and that I can't diversify my assets appropriately to be able to generate a 5% income without drawing down my portfolio, because I've got the personal results to prove it. I try to utilize the annuity. All of my explanations to my client are all about risk management. So what we're doing in constructing these portfolios, some form of asset allocation, whether it's traditional, strategic, tactical, dynamic, is all about risk management. And the analogy that I provide to the client is that this level of risk management, asset allocation, which is diversification with organization, it's like walking a tightrope, but now you've taken the tightrope from 100 feet high down to 30 feet high. And when you're 30 feet high, you can still fall off a tightrope and do some pretty serious damage. And in a small percentage of the time, you might even kill yourself. Consequently, you might want some additional level of protection, a safety net, to protect either your principal, provide a death benefit, or to provide income. But obviously, there's a cost associated. And when I provide a fair and balanced comparison between all the products standing next to each other, you know, my client may opt for 20, 25, 30% in an annuity to provide some guaranteed stream of income. Some may look at it and say, look, I've been through the market for 30 years. I get it. I don't need that at all. It's not worth the cost. Some may be very moved by it. If your approach is that the world's going to end and the market's been going up for the last X number of years, and if you want another 2008, well, yeah, that's a great way to sell an annuity. It's also a great way to get yourself in a lot of trouble. So, you know, if you'd like more information on that, see me. I can give you a balanced approach. Russ has given you a couple of selections. I'd also suggest you look at the Clark Navigator. They have some strategic income series. We're looking at a couple of other managers at this point that provide some unique income strategies where they're really designed for that distribution phase. So, you know, see us in private on that, or if anybody has any questions, you know, we can, you know, certainly cover that offline as well. Other questions? Okay, I don't see any other questions. I don't have anything coming through on the chat. Russ, anything from you in closing? I have a couple of announcements before we go. So, Russ, do you have more?
No, I'm all set on my side. I appreciate everybody attending the series, and you know, please feel free to use me as a resource if you guys have any questions.
I certainly appreciate it. A couple things just by way of reminder, folks. Again, this was the 5th in the series. Want to remind you again to check out the website, okay? And these videos will be there. So if you want to repeat, by all means, it's there. If you want a copy of the slide deck, we can make that available to you as well. If it's a situation where many of these things are actually available already on the PMC Envestnet platform. If you went into the platform information tab, unfortunately I've been signed out, so I'm not going to show you that. But if you go to the platform information tab, you're going to see them there as well. So with that, again, I want to thank everybody for their time. Thank Russ for working with us through this series. We're kind of at the end of the series. What we're going to be doing at this point forward, and I'd like to keep this Wednesday slot alive and get everybody kind of conditioned to using it. I'm going to create a couple of kind of open sessions for, questions, navigation issues. I'm going to do a couple the next couple of weeks that are going to be open agenda, ask people to provide some agenda items to me in advance so we can be prepared, but do it in a live Q&A demo standpoint, just to get people more comfortable with the navigation, with the platform, where things fit, et cetera. So keep an eye out for some advertisements for that for the next couple of weeks going forward, and then we'll go from there. With that, again, thanks everybody for tuning in today. Stay warm, stay safe, stay off the roads out there, and we'll talk to you next week.